Welcome to the deep dive. Today, we're taking a close look inside Five-Star Business Finance, FSBFL. We've got their unaudited numbers for the quarter ending September 30, 2025. That's Q2 of their fiscal 26.
Right, and our mission today, specifically for you, the listener, is to look past just the surface figures. FSBFL, they're a big name in secured small business loans. So we really need to understand how they're balancing that drive for growth against, well, some pretty clear asset quality challenges in today's credit market.
We'll be zeroing in on their strategy shifts.
Exactly, the moves that tell the real story.
And there's a real tension here, isn't there? Because management, they're calling Q2 a stabilization quarter, kind of suggesting, the worst is over. But then you look at the actual asset quality numbers compared to last year, and they show some pretty significant pressure.
That's the core of it. They clearly tapped the brakes in Q2, probably to fix some things internally. The big question is, will that sacrifice actually pay off down the line?
Let's dig into it. Section 1, the Q2 financial snapshot and their funding situation. So, headline growth first. Year over year, Q2 FY26 versus Q2 FY25. The top line figures, well, they still look pretty strong, don't they?
They do on the surface.
Assets under management, their AUM, that grew 18%. It hit Rs 12,847 crore. That's quite sizable for this kind of lender.
It is significant scale. And that AUM growth, it did boost their income. Total income was up 14% year over year, hitting Rs 8,065 million.
Okay.
And profit after tax, PAT, that climbed 7% to Rs 286 crore. But, this is where we need to slow down a bit.
Right, because 7% PPAT growth on 14% income growth, something's compressing there.
Precisely. The growth is there, but it seems to be cooling slightly. And that cooling tells us something about the current operating pressures.
How exactly does that show up in the ratios?
It really shows up in efficiency or profitability ratios. The company's growing, yes, but it's getting a bit less efficient at turning those assets into actual profit compared to last year.
Okay.
So return on assets, ROA, it came in at 7.49%. Now that sounds high, but it's actually down 87 basis points from the year before.
87 BPS, yeah, that's noticeable.
And maybe more importantly, return on equity, ROE, that was 16.91%. But that's a pretty significant drop, 211 basis points year on year.
Wow. Okay. So if you're looking at this as an investor, those ROA and ROE dips, they signal something, right? Either costs are up, maybe acquisition costs, or credit costs are rising.
Exactly. That's why the focus immediately shifts to costs, especially their funding costs. How much are they paying for the money they lend out?
And their liability profile becomes absolutely critical then.
Crucial. And this is actually an area where they seem to have done quite well in Q2. They managed to bring down their overall cost of funds.
By how much?
By a pretty impressive 27 basis points just compared to the previous quarter.
Yeah.
It landed at 9.27% for Q2.
27 BPS sequentially. That's not insignificant, especially when rates feel generally high or, sticky. That's real relief on their interest expense line.
It is. It says a lot about how the market views them. And even better, the cost of the new debt they took on during Q2. That was even lower, just 8.56%.
So cheaper new money than existing money. That's always a good sign. Shows lender confidence.
Absolutely. And speaking of confidence, there was one specific funding deal mentioned in the source material that really stands out. It's like a big external stamp of approval.
The securitization deal?
That's the one. During Q2, JP Morgan Chase Bank put Rs 6,430 million into the company's PTC's pass-through certificates. Basically, securitized loan bundles.
Wow, JP Morgan. That's a huge name and a lot of money.
Exactly. Getting a global bank like JP Morgan to invest that heavily is probably the strongest signal you could get that the market still trusts the underlying quality of FSBFL's loan book.
So whatever asset quality issues they might be wrestling with internally, the funding side seems solid, very solid.
It looks that way, yes. Robustly backed.
Okay, let's pivot then. Section 2, asset quality. This is where you said it gets really interesting.
The stabilization effort.
Yeah, we've got profitability cooling a bit, which, like you said, often points to loan quality issues. Management saying, hey, the downtrend is arrested. But those year-on-year numbers, they're painting a different picture.
A much starker picture, year on year. Let's look. Gross stage 3 assets. These are the NPAs, right? Loans 90-plus days overdue where you expect losses, they stood at 2.64%.
Okay, and how does that compare?
That's a big jump. It's up 1.17 percentage points compared to Q2 last year.
Whoa, okay. More than doubled, essentially.
Pretty much. And that's stage 3 assets. So after they've set aside some provisions, that also rose. It's now at 1.46%, an increase of 0.75% year on year.
So definitely more bad loans on the books compared to a year ago. What about the early warning signs, the stuff that might slip into NPA later?
Good question. That's the 30-plus days past due metric, the DPD.
Mm-hmm.
And yeah, that was elevated. It stood at 12.17%.
12%. So
Yeah,
roughly 1 in 8 customers is behind by at least a month.
that's right. It confirms that the stress they were likely seeing earlier in the year, maybe Q1, has definitely left its mark on the portfolio as of Q2 end.
Okay, that 12.17% feels high. So given these metrics, stage 3 up sharply year on year, 30 plus DPD quite high, how can management sound so confident? Saying the downtrend has been arrested, expecting green shoots in Q3, stronger performance in Q4. Is that just optimism?
Well, that's the critical lens we need to apply, right? Their justification seems to hang entirely on sequential stabilization. They're comparing Q2 this year to Q1 this year, not Q2 last
Yeah.
year.
Okay. So they're saying the rate of things getting worse has stopped or slowed down significantly between Q1 and Q2.
That seems to be the message, that the inflow into delinquency has been stemmed in Q2.
Do we have any data points that actually back up that claim of an internal turnaround within the quarter?
We do,
Yeah.
actually, and it centers on their collection efforts. Despite that high 30-plus DPD number, their collection metrics apparently held steady quarter on quarter.
Really? How steady?
Unique customer collection efficiency that just tracks if they got at least one payment from a customer that was flat at 95.1%. And maybe more encouraging, their overall collection efficiency, which measures total amount collected versus billed, that actually ticked up slightly.
Oh.
Yeah, from 96.3% in Q1 to 96.7% in Q2. So they seem to be, holding the line, making sure that existing pool of stressed loans doesn't get massively worse.
And they're also getting tougher on the recovery side, aren't they? Not just collecting current dues, but going after the defaulted loans using legal means.
Yes, and this is key because their loans are secured, mostly by property. That collateral gives them leverage. They've clearly beefed up their legal recovery team, and it seems to be working.
How so?
The source material specifically calls out that they resolved Rs 20 crore worth of NPAs in Q2 alone through these efforts.
20 crore recovered. That's not insignificant. It's actual cash back from bad loans.
It's a really crucial proof point operationally. It shows that the security, the collateral, plus the legal muscle can translate directly into recovered funds. It sort of validates their whole secured lending model if they execute on recovery.
Right. It shows the security isn't just theoretical. Now, what about preparing for potential future losses from that elevated stage 3 pool? What are their provisions like?
They seem to be keeping coverage up. The provision coverage ratio, or PCR, specifically on those stage 3 assets, was 45.19%.
Okay, so almost half. For every 100 rupees they classify as bad, they've already accounted for about 45 rupees in potential losses.
Roughly, yes. That's the idea. And looking ahead, management hasn't changed its guidance for credit costs for the full year.
Oh, that's interesting. What are they guiding?
They're sticking to a range of 1.25% to 1.35% of average total assets for the whole of FY26.
So keeping that guidance, even with the Q2 numbers, suggests they really believe the actions they took in Q2.
Exactly. The tighter controls, the focus on collections, the recovery efforts, they seem confident these steps will keep future losses within that guided range. They're basically signaling, we see the problem, we acted, and we think we've mostly provisioned for it.
Okay, that brings us neatly to Section 3. Those strategic shifts, the actions they actually took. And this is where that trade-off we mentioned becomes really stark, because they deliberately slammed the brakes on growth in Q2. Disbursements, new loans going out the door, were actually down 4% year over year. Only RSEC's 196 crore. This wasn't the market drying up. This was them choosing to lend less.
It absolutely was a conscious choice, an operational sacrifice, really. They talked about implementing rigorous additional controls in Q2, trying to improve the quality of new loans, likely moving away from standards they felt were maybe too loose earlier.
And there's one data point that just screams how serious they were about this.
The rejection ratio, yeah, that's the one.
It wasn't just a tweak. It was a massive shift. Tell us about that.
Okay, so the rejection ratio for new loan applications. In Q1, it was around 25%, which is, reasonably cautious.
Okay.
In Q2, it jumped to 41%.
41%. So more than 4 out of every 10 potential borrowers who applied were turned down. Intentionally.
Intentionally filtered out. Yeah, think about that. That is the clearest operational signal you can get that management saw a problem with incoming quality and took drastic action to fix it. They essentially spent Q2 building a much, much higher firewall.
Even knowing it would hit their short-term growth numbers.
Exactly. Sacrifice now for hopefully better portfolio health later.
That 41%. Wow, that really is the key takeaway number for Q2's strategy. But here's the paradox, right? They tightened the screws so hard they rejected almost half the potential business. Yet they're sticking to a really aggressive future growth target.
It's almost breathtakingly ambitious given the Q2 slowdown. FSBFL is holding firm on its guidance for 25% AUM growth for the entire fiscal year, FY26.
Okay, so let's do the math. They achieved 18% growth in the first half. If they want 25% for the full year, they need a huge acceleration in the second half, Q3 and Q4.
A monumental pivot, really. To hit that 25% target, they basically need to be dispersing somewhere in the range of Rs 1,600 crore to Rs 1,800 crore per quarter for the next 2 quarters.
Compared to the, just under Rs 1,200 crore they did in Q2?
Exactly. That's a jump of at least 33%, maybe up to 50% in quarterly lending pace, almost overnight.
So the bet they're making is that the loans they didn't reject, the ones that got through the 41% filter, are much higher quality.
And that this higher quality base, combined with more infrastructure, can actually support much higher volume safely. That seems to be the plan.
Okay, so what infrastructure are they putting in place? You can't just suddenly ramp up lending by 50% without building the capacity first, especially if you want to maintain those new high standards.
No, you definitely need the support structure, and they have been investing, both in physical reach and in people.
Like branches.
Yeah, they added 33 new branches during Q2. That brings their total network to 800 branches across 11 states and union territories.
Okay, wider reach. What about people?
Also a big jump there. They increased their total headcount by 769 employees in Q2, specifically business and collections officers.
Almost 800 people in one quarter.
Yeah.
And the split between those roles is interesting, isn't it?
It's very revealing, actually. It was roughly 500 new officers focused on business generation, finding new loans, the front end, and about 200 new officers focused specifically on collections.
So boost the sales engine, but also significantly boost the team that chases payments and handles delinquencies.
Precisely. It perfectly reflects that strategy. Ramp up volume, but have the muscle ready to keep quality high and jump on any slippage immediately.
Makes sense. Okay, finally, diversification. They're not just relying on their existing products to hit that big growth target. They've launched something new.
That's right. A new housing loan product. It actually started operations just after the quarter ended, in October 2025.
And who are they targeting with these housing loans?
It seems like a smart adjacency play. They're targeting their existing customer segments, the small business owners they already know, but it lets them offer a different, potentially larger loan product.
Okay. What are the loan sizes like and the yields?
They're aiming for relatively modest ticket sizes, average around Rs 6 to 8 lakhs. So still in that affordable housing or small property space. And the expected yields are pretty healthy, around 16% to 18%.
Still good margins then. What's the goal for this new product this year?
It's a start. The immediate goal is to build up a portfolio of about Rs 150 crore in housing loans just within this financial year, FY26.
So it contributes to the overall AUM growth, maybe 1–2% of the total book by year end, but also gives them that important diversification, spreads the risk a bit.
Exactly. Adds another potentially more resilient secured asset class to their mix.
Okay, let's try and wrap this up then, the outro.
Right. So if you put all these pieces together, what you see is an NBFC, 5-star, that looks structurally very strong. I mean, look at their capital adequacy ratio. CIR is a massive 51.04%, way above requirements.
Extremely well capitalized.
And they have confirmed security cover for their debentures, too.
Right.
So fundamentally sound. But this Q2 wasn't about pushing growth. It was clearly an intentional pause. A quarter focused on internal cleanup, risk management, marked by that really extreme 41% rejection rate.
A strategic reset.
Pretty much.
Yeah.
And management is clearly betting quite heavily that these tighter controls have now set the stage for a major but hopefully safer acceleration in lending in the second half of the year.
So what does this all mean for you listening in? I think the core narrative, the thing to watch, is that pivot. FSBFL is right in the middle of this intense balancing act. On one side, prioritizing asset quality with these super strict filters. On the other, needing to meet that really ambitious 25% annual AUM growth target.
It's a huge challenge.
They've built the capacity, they've tightened the controls, but can they actually execute that steep ramp up in Q3 and Q4 without letting those new quality standards slip? That's the defining question for the rest of their fiscal year.
Absolutely. And maybe just one final thought to leave you with, something that goes a bit beyond just FSBFL. That point about the recovery team successfully getting back Rs 20 crore of NPA in just one quarter. It's quite fascinating.
Yeah, the effectiveness of recovery.
We're seeing real, tangible proof that for secured lending, maybe the threat of legal recovery is actually turning into predictable, reliable results when pursued properly. So the question is, if this focus across the industry leveraging security through more assertive legal action, if that continues to strengthen, how might that fundamentally change things? Could it shift borrower behavior? Could it change how lenders model risk for secured loans in the future? Will that promise of collateral finally start translating into universally lower default rates over the long run? Something to think about.